market is as though it's like a subsidy on these cars. And if you do that analysis, it's probably not going to be pretty, right? Because then there should be, what that's essentially saying is that the supply should be lower than it is, right? So this is the supply with the subsidy, but there should actually be a supply without the subsidy, which is higher. So what this means is that at the new demand curve, right, what we should have is an equilibrium price and quantity here. But what we have instead is we have quantity out here and price here. And that's going to lead to deadweight welfare loss. We got lower prices, higher quantities, which presumably leads to deadweight welfare loss, right? Because, you know, the I don't know, non-interventionists would argue that the market should have shrunk, right? They were not behaving efficiently. On the other hand, one of the things that that the government intervention allowed to happen was for renegotiation of union contracts, and that historically had been what people argued made the United States not very competitive, right? So they were able to renegotiate contracts, which led to lower average total cost for auto firms, right? So what that does essentially is that changes the deadweight welfare loss calculations, right? So the idea there is that these supply curves here, these are based on cost curves. A little beyond the scope of this discussion to really talk about where that comes from, but these are based on cost curves, and a straight up subsidy doesn't have any effect on cost curves, right? Generally speaking, or it doesn't have any underlying effect on the resource costs. But in this case, it actually might, right? The problem that people would argue, you know, again, the anti-union side maybe, is that these contracts, these were inefficient. These led to inefficient allocations of labor, meaning that, you know, there were workers who would have been more useful somewhere else, but because they could capture rents because of this this collective bargaining contract, are going to work in the auto industry. And so if we have inefficient allocation of labor, and then government intervention allows there to be a renegotiation of these contracts, which leads to increases in the efficiency of allocation of labor, that's going to complicate the deadweight welfare loss analysis, right? It's not a straight up subsidy. In this case, there is actually an effect on the resource costs, right? What does that mean? Well, what this means ultimately is that it might be a good thing to have government intervention in a case like this. It might not be, but it's not as straightforward as as the subsidy example. This could allow us, right? So if we have lower ATCs, this is how you develop a comparative advantage. And so it's possible that government intervention in something like this, where you can change the structure of an industry, especially an industry where there's some sort of intransigence as a result of, or intractable structural problem. If you can use public capital to fix structural problems in an industry, that can fix the industry. And government can do this in ways that other things can't, right? So a classic example of this that I learned about way back in my TV class as an undergrad was forcing home electronics firms like RCA to collude and to collaborate. Essentially, the government said, look, you guys have to come up with some standard, and you have to work out your patent issues because people want TVs, and this made the TV possible. Before that, there were all these firms that owned different patents, and they were faced a holdout problem. Right? A holdout problem is a situation where one member of a coalition, or one member is preventing a coalition forming, and that prevents the solution to that creates an intractable problem, and the government can solve this, right? That's the good argument for eminent domain. It's a good argument for a number of government interventions, is that you can solve the holdout problem. So is it good or is it not good? The way we answer that question ultimately comes down to surplus, right? That's the way economists usually answer it, right? So we take the sum of the surpluses. So what happened? We can kind of look at these a little bit. Who are the winners and who are the losers? Well, in the short run, at least, union members lost, right? But they might get more jobs. So union members, lower wages. Consumers get lower prices. The problem with unions historically has always been that, that the people who are in the union benefit, but unemployed workers bear that cost. So the winners here are unemployed workers get jobs, and because we possibly could earn, taxpayers could earn a profit, or at least get our money back. It's unclear whether taxpayers benefit or suffer, right? So there's risk versus reward, and to be honest, I haven't looked at the numbers, so I'm not sure what that looks like. But in principle, loaning money like that is kind of a wash. So we got union members get lower wages, consumers get lower prices, unemployed workers get jobs. Obviously, firm owners get increased value of their capital. Their machines are not lying idle. And those are kind of sort of, what's going on here. How this works out, well, if you're not being ideological, right? If you don't have a just a straight up opposition to the prospect of government intervention, then I think it looks like this was a good thing, right? It's possible that people should be moving, that these jobs should be moving somewhere else. Then again, there's a lot of fixed capital already there, and if the problem really was, right, if the problem really was this, the unionization problem, right? You had this sort of these retirement funds that were being underfunded, and you had these wages that were just too high to be competitive, and then that led to shutdowns and unemployments. Then this is probably a good thing, right? If the capital was already efficient, and these are good factories making good cars, and the evidence seems to suggest that these cars are good and getting better in quality, then solving that intractable problem through an infusion of government money probably was a good use of government funds. Again, that's a normative question, though. I'm not sure that everybody's going to agree on that. But yeah, so there we go. Detroit automakers are struggling to keep up with demand. They're trying to build and open factories, and it's going to take them a little while because supply is more inelastic in the short run. And so what will happen is the quantity went down, the quantity is going to go back up, but first prices are going to rise. Prices should fall after that as the output capacity expands. To analyze this, the common example would be to treat the loan of money as a subsidy, right? We're subsidizing them through low interest rates. But in practice, because they renegotiated contracts, there was an effect on the cost curves. That effect on the cost curves changes the analysis. It's not clear that there's going to be deadweight welfare loss. It's possible that we could be redeveloping a comparative advantage as a result, because these structural problems have been fixed, just like when TV was, allowed to happen. It's possible that what happened was we solved the holdout problem. Whether this was a good thing or not, ultimately most economists would agree that it comes down to the sum of the surpluses. Right, there are winners and losers, but if the benefits to the winners outweigh the losses to the losers, and in this case, it's not entirely clear who the losers are, right? Because union members are getting lower wages, but they were losing their jobs, right? So if the auto companies went out of business, they certainly would have lost. So it might be very well that this was just a win-win situation. Clearly, the use of public funds means that there was some risk there, and so there's a potential loss there. Actually, you know who's a loser? The losers are Japanese automakers, right? Companies that would have taken the surplus if American automakers went out of business. So those are the losers. Should American taxpayers care about the wealth of Japanese shareholders? Some people have stock there, so yeah. So shareholders in Japanese firms are suffering as a result. Ultimately, I think the U.S. government probably has an interest in maintaining, um, maintaining some jobs here, especially if what they're doing is they're solving this structural problem, and because then it means that Japanese consumers also benefit from lower prices, because these lower prices are actually represented by lower costs. So there you go. That's my quick analysis. If you have any questions or comments, feel free to post them. I'm not sure I'll be able to respond to all of them, but I'll do what I can. Thanks, guys. Bye.